So, good evening, everybody. Welcome to this evening's Medics Money webinar brought to you with RBP Chartered Accountants. My name's Dr. Tommy Perkins, and I am one half of Medics Money. First things first, thank you so much for joining us this evening. Over 2,000 doctors registered for this webinar, which is incredible. And, you know, like us, you've probably been at work all day today, you've rushed home, walk the dog, put the kids in bed. So thank you so much for joining us here today. As I said, I'm one half of Medics Money. The other half of Medics Money is Dr. Ed Cantello, who, like me, is a doctor as well. But Ed is also a chartered accountant and chartered tax advisor. And Ed is running the chat today. So if everybody heads over to the chat room, just to introduce yourself, say hi to Ed so he doesn't get lonely. And also to just let us know whether you're an F1 or a GP or a trainee, and what you're hoping to get out of this evening's webinar. So I'll just give everyone a bit of time to settle in and say hi. So hi, Haroon. Hi, Nadia. There's a lot of people saying hi. We've got over 587 people in the room at the moment. So Ed's going to be busy in the chat room. So if you're having any technical problems at all, the solution to all technical problems is to use Google Chrome as your default browser. So it works best on there. So lots and lots of people saying we've got some anesthetics. We've got Imogen, who's pediatrics. Great. Okay. So thanks so much for introducing yourselves. So the chat is where you can ask questions. So some of you, or lots of you, pre-submitted questions already, and we will definitely be taking those. But we will also be taking questions from the chat. So while you're just introducing yourself in the chat, a quick disclaimer to say that everything that you see this evening is for information purposes only and does not recommend constitute advice. And as ever, we would always recommend, if you are unsure, that you get advice from a suitably qualified person. Great. Right. What I think we should do now is introduce our speakers for this evening. Shall we start with you, Jenny?
Yeah, that's fine. I'm Jenny Stone. I'm one of the partners at RBP Chartered Accountants, and we're a leading firm of medical specialists. So I'm here more for the accounts and tax side of advice.
Excellent. Thanks, Jenny. Nice to have you here. And Steve?
Hi, everyone. I'm Steve Capps, and I'm a director of Ramsey Brown Financial Services. I've been dealing with doctors since 1992, so I've seen lots of changes in the NHS pension scheme, and basically we provide help and guidance for clients who need financial planning services.
Excellent. So what I think we should do is, what we're going to do is we've got some questions that people submitted via email, and we're going to do those. But why don't we start the presentation first, Jenny, and then we'll jump into some questions. After about 10 or 15 minutes, we'll do some questions. We'll do some questions after another 10 or 15. We're aiming to make it last about 40 minutes, and then, because we know everybody's time is precious and everyone's been at work today. So, although you've probably watched everything on Netflix, I know I have during lockdown, so this is the best entertainment right now. Shall we jump into the slideshow, Jenny?
Yeah, thanks, Tommy. Good evening. Thank you all for joining us. Just to let you know, really the format, as Tommy said, we are going to take questions in the middle of the webinar and at the end, but Steve and I are going to have a discussion about the NHS pension scheme, lifetime allowance, annual allowance, and obviously tapered tax as well. So Steve, can I ask you, Steve and I have worked together for about 20 years, so and years ago, people would never ever think about opting out of the pension scheme, and I certainly see younger doctors sort of actually considering this. So Steve, can you just sort of explain what are the benefits of the NHS pension scheme?
Well, the major benefit is that it provides a guaranteed inflation-proofed income from when people retire for the remainder of their lifetime. So you've got a pension that will be paid, it's government backed, so it's as secure as it can be. for as long as you're in retirement. It also provides death in service benefits, so that if members die whilst in service, they get up to 2 times their annual pay as a death in service payment. And there are also dependence benefits for partners, children, and so on. So it's a guaranteed scheme that provides significant benefits for its members. One thing to remember about the NHS pension scheme is that it is a defined benefit scheme. And a defined benefit scheme means that you get a pension based on your lifetime earnings or your final earnings for the rest of your life, without any of the risks associated with other types of pensions. And the NHS pension scheme is probably the best, if not one of the best pension schemes in the UK. Now, most big employers are moving away, or have moved away, from this defined benefit type arrangement. So they have introduced what are commonly known as money purchase arrangements or defined contribution arrangements. So whereas with the NHS pension scheme, you get a pension that is based on your lifetime earnings or your final earnings, and all of that risk of the inflation rate, the investment returns, so investing in the stock market, and also the cost of buying a pension when you eventually get to retire is taken away. And so definitely it's something that people should think very, very hard about before leaving.
Yes. Yeah, I know, Steve, you made a comment to me once about I'd cut my right arm off to be in the pension scheme. Steve, we were just going to mention about annuity costs, weren't we? So I'm just going to put up the slide just to show you. So here we were going to talk about, so people will, this will be a total reward statement that you would receive if you want to know what's in your pension. This is a total reward statement. So this is for 95. If you're in the 2008, and then obviously transitioned over to 15, you'd have one for 95 and 15, or 2008, 15. And this shows you what your pension benefits are. So this will say what they're up to. But I think, Steve, you were going to touch on about actually what it's worth, this pension, and I'll let you.
Yeah, I mean, I think I would definitely recommend that all members get their total reward statement from the NHS every year and look at what their pension benefits are and how they've improved. And if we take this as an example, I mean, this is an individual whose pension benefits as at this particular time, and this is to the 31st of March 2015, has a pension accrued of £24,110 and a lump sum of about 72,000, etc. Because this is the 95 scheme, there's an automatic lump sum. So you get a pension and the lump sum is 3 times the pension. But if you go down to the hypothetical annuity cost, this is a sort of estimate of what it would cost to go out and buy these benefits in the market. So in order to buy those benefits, and bearing in mind it's an inflation proofed with a 50% partner's pension, to buy those benefits would cost in excess of £1.2 million. So it's a huge amount of money. And this will give you some idea of the value of what you have. Annuity rates at the moment, and this is one of the things I was sort of alluding to earlier, annuity rates at the moment are extremely low because they're based on interest rates and they fluctuate so much, and they're also based on how long people live. So as mortality rates improve, the cost of buying a pension goes up, but none of that cost is actually borne by the members of the NHS pension scheme. It's borne by the scheme itself. So it takes away all that risk and uncertainty.
Yes. And it might just be worth me sort of just touching on what it actually costs you to obviously buy these pension benefits. So you will pay an employee contribution. The employee contribution is based on what you earn. So I've just put up here what the tier rates are. Now, if you are a hospital doctor, you are what's called an officer. So the rate of employee contributions you pay is based on your whole time equivalent. If you are a GP, you're a practitioner for pension purposes, so your tier rate is based on all your NHS earnings. So if you were a salary GP and you were working for out of hours, which is pensionable, you've got to add the two together to determine your tier rate. And it is important you set the tier rate at the right level, especially for GPs, because you may find you end up having shortfalls to pay. GP partners pay employers pension contributions. So I've put the rate here of 20.63%. That is the actual rate, but at the moment GPs are only paying the 14.38% because the rest is centrally funded. So that's what it's costing you a year for your pension benefits. Steve, can I just move on? So we're going to cover two of the tax implications. So the annual allowance we will come on to, but what I also want to talk about is the lifetime limit. So if, let's say I was a doctor, let's say I was thinking about retiring next year, what is the lifetime limit and how do I know what the lifetime value of my pension is?
Right, well, the lifetime limit currently is £1,073,100. That might seem like a very strange figure, but the figure started, it was reduced down to £1 million, and it goes up each year in line with the consumer prices index, rounded to the nearest £100. So currently up to £1,073,100 is the maximum that you can accrue within your pension pot, and that's from all sources except for the state pension, before you hit your lifetime allowance. Now, once you hit that lifetime allowance, any excess is then subject to a lifetime allowance tax charge. Now, one of the things I have seen in some of the pre-submitted questions is people asking, when do I hit my maximum? It's important to recognize that the 1.073 million is not a maximum. It is the lifetime allowance. You can have as much as you like. It's just that any excess is going to be subject to tax. And even after tax, that might still be a reasonably good deal.
And just also worth mentioning that actually when any of the information you get from the NHS Pension Agency, it doesn't actually tell you what your lifetime value is. So if you look at this total reward statement, let's go back to the 95 one, nowhere on here actually says what your lifetime value is. So I get a lot of clients say to me, oh, Jenny, my value is 1.2 million. I'm over the lifetime limit. But actually, it's not over the lifetime limit. So nowhere on this statement tells you what the lifetime value is.
The lifetime limit is calculated by multiplying your pension by 20. And your lump sum is then added in. So if you're in the 95 section of the NHS pension scheme, then your lifetime limit can be calculated by multiplying the pension that you have accrued by 23. So that's 20 times the pension plus the lump sum, which is 3 times. For the 2008 and the 2015 scheme, there isn't an automatic lump sum. It's optional. So whatever your pension accrued is, you just need to multiply it by 20 to actually determine what you have in terms of a lifetime allowance amount. The interesting thing to do if you go back to the previous total reward statement is that the actual cost of buying that pension is 1.2 million. The actual value in terms of lifetime allowance purposes is significantly less.
Yes. And I've just put on here with the slide I've put up is just sort of what is, if your pension benefits are at these levels, that means you're going to exceed the lifetime limit. So Steve, let's say I actually had no idea about the lifetime limit and I've come to take my pension and I find I'm above the lifetime limit. How is the actual tax charge going to be calculated?
Right, so if you exceed the limit, then the excess is going to be subject to a lifetime allowance charge. Now, that lifetime allowance charge will depend on how you take the excess. You will have a choice. You can take the excess as a one-off lump sum, in which case there will be a 55% tax charge on that excess. Or else you can take the excess as a pension, in which case the pension will be taxed, the excess will be taxed at 25%, and then the residual pension that you receive will be taxed in the normal way based on your marginal rate of tax.
Yeah.
It's also important to stress that within the NHS pension scheme, of course, you can't take the excess pension as a lump sum. It is automatically subject to a 25% tax charge. So if your excess pension was, say, £10,000, it would be subject to a 25% tax charge. And so therefore you would only receive £7,500 a year, because the rest would be paid off to HMRC.
Yes. Okay. And
just finally on that, I mean, when I say 55% for the lump sum and 25% for the pension, in the scheme of things, they're very, very similar, because if you take the pension, the excess as a lump sum, and you've paid 55% on it, then the rest of that excess is tax-free. If you take the pension and you've had a 25% deduction, the £7,500 is then going to be taxed, likely at 40% or more.
Yes.
So therefore, the overall figure is around about the same, about 55%.
Yes. Yeah, I think people think, oh, 55% tax versus 25% tax, without realising that actually that 25% you're taking, you'll then pay further tax on it. So yeah, no, that's good to make that point. And Steve, if I'd exceeded my lifetime, is there anything I could have done to have actually protected my pension pot? In terms of, if depending on when you're at your limits, could I have done sort of applying for protection?
Well, they're the only protection that people can really apply for now is individual protection 2016, or possibly fixed protection 2015 if they haven't made any contributions since the 5th of April 2016. And this will protect your pot up to 1.25 million, which was the lifetime allowance before 5th of April 2016. Provided the pot was worth that much at that point in time.
Yes.
And now, if it was worth that much, or if it was worth more, there would be a maximum of 1.25 million. Then you need to apply for individual protection. You do that through the HMRC website, and they send you a little protection certificate.
Yes.
Now, it could be somewhere between 1 million and 1.25 million. But it can't be more than 1.25 million. And in order to actually apply for that protection, members need to apply to the NHS Pensions Agency for evaluation of their pension pot as at the 5th of April 2016. But that is the only thing that is available now.
Yes, no, that's right. And I was going to say...
Sorry, but people may have other protections. They may have fixed protection or individual protection 2014, 2012, or even primary enhanced protection back to 2006.
Yes. And I think, Tommy, before we moved on to the annual allowance, I think you were going to possibly put in some
yeah, absolutely. So so first things first, there's over 800 doctors watching this webinar. Me and Ed work so hard at Medics Money, and Jenny and Steve, thank you for joining us. So it means so much to have so much support. The implication of there being 800 people or doctors watching this is the chat. That's why I went away. I was just in the chat. It's so hectic. So we're going to try and cover everything. So first of all, we're going to do some pre-submitted questions. A lot of the questions in the chat are going to be covered by the presentation, so stick with us. The two big ones as well are, yes, the replay will come out and you'll get an email about it. And I think, Jenny, you're going to have the slides as well. So that will happen. Okay, let's get into the questions. So the first question is, I think this is to Jenny, really. Is from Beth. I'm a newly qualified GP locum receiving NHS employer and employee contributions into my account before transferring them to Primary Care Support England. I mean, let's not talk about PCSE. What Beth wants to know is, in my annual turnover, do I include both the employer and the employee pension contributions? And does the NHS pension, when paid this way as a locum, claim relief at source? So this is a really common mistake that we see non-specialist accountants make. Jenny, tell us the answer.
Okay, so if you're a GP locum, you raise an invoice to your practice and you will be and they will pay you. You do the locum AB forms and they pay you the employer's pension contribution. I would say the simplest way to deal with this is if you've invoiced £1,000 and you're going to get paid £1,114, show that as your turnover, but make sure you claim employees' employer contributions. The only issue is then you're matching what you've received in your bank to what you're declaring in your tax return, and then what you're paying to PCSE will agree to what you've claimed. And then obviously make sure you're claiming what you've paid in Superannuation contributions onto your tax return. So the net effect is the same, but I think that's the simplest way because you can tie up what you've received and what you've paid.
Yeah, I think the super simple answer is to get a specialist medical accountant if you're a GP locum. Being a GP locum is hard enough without having to worry about all of that. And let's not talk about
I was just about to say, if you're GP locum, just because I was dealing with the client last week, it's really important to keep copies of all your locum A and B forms and check your pension records. So like Steve said, get a copy of your total ward statement every year and check. I dealt with a locum where she'd sent me copies of everything, and what was on her pension record was actually only 3 months of her income, because I don't know what PCSE had done with the rest of it, but she'd paid it. So really important, yeah.
That's me as well. PCSE in 2017 to 18 thought that I contributed £63 to my pension. Yes. I can tell you that it was an order of magnitude bigger than that. So that was fun. But luckily, just keep the paperwork and get a specialist medical accountant. The non-specialist accountants make that mistake all the time. Okay, Patrick is an A&E consultant, and he says, he's found it fiendishly difficult to get information online. That's what Medics Money is here for. But his question, I think this is for you, Steve, really, and there may not be an answer. I wondered if you could compare the benefits of contributing extra to the NHS pension via additional pension versus getting a self-invested pension instead. Am I getting any more bang for my buck, particularly in terms of additional income tax breaks, by using the NHS additional pension versus a SIP?
Right. Okay. Well, there is no absolute answer to that question. But the first thing to say is that a self-invested personal pension is just a personal pension. I mean, it just gives you more flexibility in what you invest your money in. But the thing to remember is that whatever you do invest in, you're going to get returns based on those investments. And that is going to be unpredictable. It doesn't matter what you put your money into. The additional pension is just the same as the main scheme. It provides a guaranteed inflation-proof benefit, and that benefit will be paid when you retire, and it will be inflation-linked from the point that you bought it to when you actually stop working. The additional pension you can buy in chunks of £250 up to a maximum of £6,500 a year, and actually to know which is going to be better will depend very much on the circumstances when you actually come to retirement. But we do know that one of them is going to give you a guaranteed pension in retirement. The other one's going to give you a pot of money that you'll be able to convert into an income in retirement, which will be based on all sorts of variables that can't be predicted in advance.
Yeah, I mean, we've got another... Sorry, Steve.
So I was just going to say, in terms of bang for your buck, in terms of tax relief, it's the same. You get tax relief on your contributions, provided you don't, well, you still get the tax relief, provided you don't exceed your annual allowance, in which case you'll get the tax relief, but you'll have a bit more tax to pay.
Yeah, and a lot of people asked, we're going to do this question later, but basically they know that they want to retire early. They don't want to work. My pension age is 68. No way am I going that far. No way. So we're going to talk about that later, because that is a complex but interesting question. Okay, one more question then, if that's okay. Again, we've had this one a few times. So Andrew started a bit later than normal in medicine. He graduated in July 2012 and has been in continuous NHS employment since then and is now a GP partner. How will entering the pension scheme later affect his pension?
Well, he'll get a smaller pension than if he'll have started earlier. But it depends, obviously, on what he does between now and retirement. I mean, clearly, he's going to have less time in the scheme, but you can work in the scheme to 75. That's when you have to, take your pension benefits if you want to. I'm sure that's not what most people have in mind, but there's not anything that Andrew can really do to make up for the time that he wasn't in the scheme, but he can buy additional pension within the scheme to boost what the accrual that he will have between joining and retiring.
And if he's a GP partner, his pension is based on obviously his earnings for the rest of the career. He might have gone into a partnership where he's high earning, so compared to somebody who might be in a lower earning practice. So it's that could also he could actually be accruing more pension just because he's earning more.
Awesome. Okay, shall we jump back into the slides?
Yeah,
and then we'll do some more questions later. And I'm going to dive back in the chat because there's lots going on in the chat. We've still got 807 doctors here, so yeah, let's do it.
So what we're going to be wanting to talk about now is obviously the annual allowance. And I know lots of my clients, people say to me, I hear horror stories about the annual allowance, and I'm sure I've got lots I can tell you. But what I want to start with is really just asking you, Steve, because I know when I go out to talk to my clients, I spend a lot of time talking about the annual allowance and tax charges, and there is a lot of lack of understanding. So Steve, can you just explain what exactly is the annual allowance and how is it calculated?
Right, well, the annual allowance is probably the most controversial allowance that we've seen, particularly from the point that the taper started. So the annual allowance is the amount that you can allegedly pay into your pension scheme in a year without being subject to a tax charge. And the standard annual allowance is £40,000. So you can make contributions, or in the case of GPs, deemed contributions, and I'll go back to that in a moment, up to £40,000 without incurring an annual allowance charge. If you go above that £40,000, then you are subject to a tax charge. The excess is then added to your income, and it's taxed at your marginal rate of income tax in that particular year. So 40,000 is the standard annual allowance. But then in 2016-17, we entered a situation whereby the government introduced a tapered annual allowance. And that said for high earners in particular, that if you were earning over a certain amount of income, then that £40,000 would be gradually reduced so that you would have a lower annual allowance. And for people up until the current tax year, so the 2021 tax year, the annual allowance could be reduced to as little as £10,000. For the tax year 2020-21, the actual minimum annual allowance, so that it can be reduced to a minimum of £4,000. However, there is a difference between the two in that the income thresholds for the 2021 tax year are much higher. So for the annual allowance, the tapered annual allowance for 1920 and years back to 16-17, if you earn more than 110,000 as your threshold income, so if your total income minus your pension contributions was 110,000 or less, then you weren't affected by the taper. And total income was income from all sources.
I was just about to say that
rent, interest,
also,
investments, whatever. So if your total threshold income was over £110,000, then you need to add back in the employer contribution, or the deemed contribution from the NHS pension scheme. And again, I will go back to that in a moment. Once that is added, if your adjusted income, which is your threshold income, plus the additional bit, which is the deemed growth in your NHS pension, takes you above £150,000, then your taper would be reduced by £1 for every £2 over, which means that people who had an adjusted income of over £210,000 would see the maximum reduction of £30,000, so they would only have £10,000 of annual allowance. Now, for the tax year, the current tax year going forward, that threshold level, that threshold income is now £200,000. So if your total taxable income from all sources is less than £200,000, you're not affected by the taper. But if you are over the £200,000, then you need to add in the deemed pension contribution. And if the adjusted income is then over £240,000, you then start to lose £1 of your annual allowance for every £2 you're over. And this now can be reduced to a minimum of £4,000. So for anybody earning more than £312,000, they will see their annual allowance reduced to £4,000, and that means you will be subject to a tax charge on that excess. Now, in terms of how to work out what you've contributed, for people in the NHS pension scheme, it's not as simple as what have you paid in contributions, unfortunately. It's how much your pension has grown by each year. So that can only be worked out by the NHS. So what you need is the NHS Pensions Agency. So what you're going to need is your annual pension savings statement. That will tell you how much pension growth you've had in the year and the previous 3 years. And then you'll be able to add that. If you are in that situation of being a very high earner, then if you're in that situation, you'll be able to add that growth to your income to determine how much annual allowance you have left. You can carry forward unused allowances from the previous 3 years, And also, if you have had charges in the previous 3 years, you may have some unused allowances from the years before that, but you can only go back 3 years in terms of bringing forward unused relief.
And normally, if somebody's been subject to the taper since 2016-17, they're not really going to have much unused annual allowance left anyway.
No.
Just one of the slides we did that I've just put together, I just did a quick example just to really demonstrate the difference in the tax charge. So this was an example of somebody whose taxable income was 156,000, pension growth of 58,000. And again, it's really important to say what you contribute is irrelevant. So I have clients that say to me, oh, Jenny, my pension contribution says 20,000. I'm less than 40. I don't have anything to worry about. What you pay is irrelevant. It's about calculating what is your deemed growth in your pension. So with this slide, all I'm saying here is in 1920, which is the current tax year that we're doing tax returns for, this doctor is still subject to the maximum taper. I would have a tax charge at the highest rate of 45% of 21,000. But going forward for 2021, so the next tax return, so the tax year we're in, they won't be subject to the taper, so their tax charge will be 8,100. So they will still have a tax charge because their growth is above 40. So I think some people think, Steve, that, oh, people aren't going to have tax charges anymore. Well, yes, you are. If your growth is above 40, the standard, you might not have so much to pay when the threshold limits were that much lower.
Yeah.
It might just be worth me sort of just going on to talk about how do you know where you've exceeded that annual allowance. So as Steve has said, the pension agency will send you a statement to confirm what your, sorry, I'm just going to show you an example of an annual allowance statement. Apologies. So if you've had one of these, this is all to do with your annual allowance. So the NHS Pension Agency are the only people that can calculate your growth correctly. So once they've done that, they will send you one of these annual allowance statements. And it's also worth noting that because we have we have three parts to the pension scheme. We've got 95 in 2008 and 15. So if most people have transitioned over to the 15 scheme, you're going to have one that's going to be headed up 95 2008 and one that is also headed up 2015. So this will be the annual allowance statement that you will receive. This will show you your growth and then obviously previous years. Now, again, if you're in both schemes, this is not 33,000 growth compared to 40. And then when I look at the next one in 15, my growth was 39 compared to 40. You've got to add your growth together for the two schemes. So actually for this particular client, they've got growth of 72,000. So even if they had a standard annual allowance of 40, they would have exceeded it. Now, if you are a hospital doctor, usually for 1920 annual allowance, the pension agency will send a statement to you from October 20. So you would get this in time to deal with your tax return. I say hopefully, because I have had some hospital consultants that haven't received them, and therefore we then have to do an estimate. But if you are a GP, you need your accountant to look at this and do the estimate for you, because if you're a GP, you don't declare what your pensionable earnings are for 1920 until February 21, which is already after the deadline, the tax return filing deadline. And then if you want to elect for the scheme to pay, that election's got to be made by July 21. A GP at the earliest can expect one of these statements in October 21. So it's already past filing deadlines for tax returns and paying tax and scheme pay elections. So it's really, really, really important that your accountants are doing this if you haven't got a annual allowance statement at the point of doing a tax return, that your accountants are doing an estimate for you. And I've got, people have had, you don't want to be landed with a surprise, oh, I've got 30,000 tax bill to pay and you've missed the scheme pay deadline. So all I would say is it's important, certainly we sort of say to our clients, send us your pension information. We need to know what your starting pension is so that we can make those estimates for you. And if you have a tax charge, so if you have exceeded the annual allowance and you've got a tax charge to pay, you can either pay that. So you either make a decision: do I declare that on my tax return? And if you've got a 1920 tax charge and you wanted to pay it, then you would pay that in January 21. Or you can elect for the scheme to pay the tax charge for you. And as I said, you have to do a scheme pay election form. Steve, can I ask you, so one of the questions I always, we always talk to our clients and say, do you want to pay the tax yourself? Do you want to ask the scheme to pay? But can I ask you, Steve, if somebody makes a scheme pay election, how does that actually impact on their pension?
Right, well, if somebody makes a scheme pays election, then the scheme will actually pay the tax on their behalf to the HMRC. Now, there are two types of election: those that are above the standard allowance. So if your growth is above 40,000, the scheme will pay that growth on what is called a mandatory basis, which means that they are joint and severally liable with you for the tax charge. So therefore, they make the payment to the HMRC, and whenever the HMRC get it, that's dealt with and it's fine. If you have a charge that is below the 40,000, so if you've been tapered and you have, say, 30,000, so you're tapered down to 10,000, there is 30,000 of annual allowance that is in excess that needs to be paid. Now, the scheme will pay that now. Didn't used to, but that's what caused a lot of the problems. The scheme will pay that now, but it does so on a voluntary basis. And so therefore you need to get your election in a lot earlier, because if you miss the 31st of January deadline for the payment, then there could be interest on any tax that hasn't been paid or any incorrect tax. But in terms of how it impacts upon the eventual pension, the scheme will essentially make the member a loan, and that loan will then be subject to interest, which is 3% plus RPI, or was RPI, it might be changing to CPI. But the idea behind that is that the government actuary department calculates the loss to the scheme. So essentially what is being reclaimed from people when they get to retirement is the cost to the scheme itself. The government and NHS do not feel that the other members should be subsidising those who elect to use scheme pays. And that will then be converted, whatever the debt is will be converted into a figure, and that will then be deducted from the pension and from the lump sum at retirement. What it is will depend on factors that we don't know at this stage, but the alternative to using scheme pays is, of course, paying it personally. And paying it personally, as I say, was what caused a lot of the problems in the first place, because it causes cash flow issues. You have to find that money. So you're paying that tax now, albeit you're not getting the benefit of your pension until you retire. So electing for scheme pays, yes, it will reduce your pension when you retire, but it would improve the cash flow today, and that cash flow could be used for other things. It could be used for paying off debt. It could be used for funding lifestyle school fees or whatever. So it's a fine balancing act. One has to take a view.
And I think that's very much, it also depends on the affordability, doesn't it? Because we've seen clients that have had significant tax charges, and then when we say, well, this is what we're estimating your tax charge to be, they'll be like, well, I haven't got the money to pay that. They've just about saved enough money to meet their income tax liabilities. So quite often people do end up electing for scheme pay elections purely because they don't have the cash now. And just to mention the deadlines for scheme pay elections, just because it's really important that you have to submit, sorry, I'm flicking through the slides. You have to submit your, so quite often, even if you haven't had a final annual allowance statement, you can submit a provisional scheme pay election. So if you're wanting to ask the NHS Pension Agency to pay your tax, you do a scheme pay election. And the deadline, so for example, tax returns that were done last year, if you had tax charges, then the deadline for asking the scheme to pay is the 31st of July 20. So as long as you've got your scheme pay election in by that day, then that will be accepted. And then obviously when you get your final annual allowance statement, you have sort of 4 years afterwards to make that amendment. So, certainly for GPs who never get an annual allowance statement in time, we will be doing estimated tax charges, estimated tax return charge, estimated scheme pay election, and then all of that has to be amended once you get the final information. And all I would just also mention, the 31st of July 20, because of the current situation, has been extended to the 31st of October 20, but that's only the voluntary election. So all I would say to anybody that is concerned that last year they had an annual allowance tax charge and they would want the scheme to pay it, just make sure those scheme pay elections go in by July.
And of course, the annual allowance issue and not being able to have the scheme pay the difference between the 40 and the tapered, that was what caused a lot of the problems with people doing less work, not taking on jobs, opting out of the scheme, because you're actually paying a tax charge on income you haven't received. It's income you're going to receive when you retire.
Absolutely. And I was just going to go on and say that obviously, and that's exactly what I've seen, people have chosen to work less, not take on extra shifts, reduce sessions because of this tax charge. What I was going to say was just to mention that the announcement that the government made for 1920. So there was this announcement to say that if you've got a tax charge for 1920, so that's the tax year now that you're doing, that the government have said you will be no worse off if you have a tax charge. Now, how that's going to work, there's not a lot of detail about it, but what they've said is you would have to make a scheme pay election for the tax charge, and then you would be compensated at retirement for that reduction in your pension. So let's just say for 1920, as Steve has said, there's so many different factors. You don't know what the effect on your pension would be, but let's say the tax charge meant that your pension got reduced by £500. What the basic guidance says is that the trust will compensate you when you come to retire. How it will work for GPs, there's no detail because you don't have an employer. So as they always say, the devil's in the detail and we don't know what the detail is. But certainly there is this commitment that you shouldn't be worse off as a result. Steve, the only other thing I was just going to mention was, with people that do have large amounts of growth, so they may not be subject to the taper for 2021 going forward, but they're still exceeding their standard annual allowance of 40,000. Is there anything they can do to reduce the growth in their pension?
They can work less, as they have been doing. They can opt out of the scheme, which would mean that they wouldn't have any further growth because the pension that they've accrued would then be preserved and would just go up in line with inflation, and therefore there wouldn't be any annual allowance excess. Apart from that, I don't really see there's a great deal else that they can do. I mean, they could take 24-hour retirement if that's an option, because that brings the pension into payment. Once the pension's in payment, you have no further growth. But all of these things will impact upon the ultimate size of the pension. And if you use scheme pays, even with a tax charge, it may still be a better option than coming out of the scheme, bearing in mind you're getting an employer contribution if you're an officer, and you're being compensated for the employer contribution within your GP global sum or whatever.
Yes. And I know I've got quite a few people are sort of choosing to opt out. What benefits are people losing by actually opting out of the pension scheme?
Well, once you've opted out, your pension is then preserved. So whatever you've accrued to that date is protected, and it increases each year in line with inflation. Whilst you're an active member, your pension will either go up by the annual accrual if you're an officer, so whatever, depending on which scheme you're in, the 95, 2008 or the 2015. If you're a GP, then your lifetime earnings will be revalued each year by inflation plus 1.5%. Now that can be quite a lot if you're been in the scheme a long time. So you are losing that. That's the first thing you're losing, is that extra accrual, and in particular the extra 1.5% uplift, which of course you're not paying for. You only pay for the accrual in the year. The other things you lose, of course, the death in service benefit, the ill health benefits, and so on and so forth. They will be reduced, significantly reduced, if you come out of the scheme.
And I certainly say anybody that's thinking about coming out of the scheme, they should be taking advice about, you know, whether that is the right thing for them to do. Just one final question, Steve, just before we move on to questions, is, I think, Steve, you and I thought we knew the answer to this, but the whole issue about the annual allowance is because people can't pick and choose how much they pay into the pension scheme. You have to pension all your NHS earnings. Now, so there was a consultation last year about pension flexibilities, and that you may have the option of choosing how much you pay into the pension. Now, Steve, what has actually happened to that consultation?
Well, I've heard sort of, oops, what's gone?
It's Steve, if you just hit the button at the top to turn your video back on.
Sorry, is that it? Yeah, turned it on, is that?
Oh, we can still hear you. We might have to do without your face for a tiny bit.
Okay, all right, okay, there's technical issues. Okay, so yeah, the pension flexibilities was part of a consultation, and as far as I was aware, that nothing had been decided. We then had the budget, which increased the earnings threshold for taper. I have seen rumours, or I've seen some evidence that they are still thinking about doing that. How it will work, I have absolutely no idea. If it works as well as the other stuff that happens within the NHS, then I suspect there will be a lot of paperwork flying around that perhaps you know, sort of might cause more issues going forward. Yeah.
I was going to say, I think if people realise it's complicated enough, I must admit I was kind of dreading what was going to come out of that, and the added you know, how complicated it would start to get. Tommy, I think that was sort of enough of our discussion. We wanted to kind of try and keep it fairly simple. So
yeah,
just to go to you really with questions that you've had come in.
Yeah, absolutely. So let's get into the questions. There's so many, but we're going to try our very best to get into them. Now, a lot of people have been saying, do I really need to know all this? It seems really complicated. We have been getting in pretty deep tonight, but unfortunately, all doctors need to know this stuff. So you can watch this webinar on replay in your own time, go through it slowly. The Medics Money website is a great source of pension information. We've got a dedicated pension section on our blog. The NHS Pension Agency website is actually quite good as well. So a number one question, or not number one, there's loads, but a really frustrating one is inaccurate total reward statements, or even worse, I mean, we're going to say it again, PCSE, Primary Care Support England. So firstly, if you've got your total reward statement, great. And if you haven't,
that's a miracle in itself.
Yeah, I mean, mine was last accurate in 2016, extremely frustrating. But if you haven't, and you're F1 and you're sat there thinking this is way too above my head, your one take home for today is to go to totalrewardstatements.com, I think it is, and get your total reward statement, and do that every year. You must do that.
You have to do it. I mean, I have clients even now who say to me, I know, you know, 15 years ago, I haven't got all my hospital work recorded on my pension. So you've actually paid all those contributions. And, you know, I had a client that said to me, I'd have to go down to the hospital to get the information. So I absolutely, you have to get your total reward statement. You have to be checking it every year, because there are, you know, and certainly for GPs, you know, there are lots of errors in terms of capita, PCSE, there's delays in them processing information. So it's really important. And I would also say if there's any, obviously, salaried GPs watching, I think salaried GPs' total reward statements have been more of a problem as well, because they haven't realised they've got to do a Type 2 pension certificate. So if you have been a salaried GP, you are required since 2009-10 to do a Type 2 pension certificate. And if you haven't done one, that's probably part of the reason why your total reward is not correct. There is an amnesty, so the Pension Agency issued an amnesty last year to get salaried GPs to be doing that information. But yeah, absolutely need to be getting your statement and checking it.
Yeah, and you know, errors in those figures are so common. It's incredibly difficult to spot yourself, but just get your statement and get familiar with it. If you're a consultant or a GP and you're unsure, you know, you need to start thinking about taking advice fairly sharpish. But you know, if you're sat there as an F1 thinking, oh my goodness, scheme pays, annual allowance, whatever, if your one take home from today is that the NHS pension is still a pretty good deal, if you make any changes to it, you should take advice before doing so, but just get your total reward statement. That's all you got to do. Okay, we're going to get back in deep. I don't know where Steve's gone. He He's going to come back. So a quick one, bit morbid this, but what happens to your pension if you were to die?
Is Steve here?
Steve? Okay, let's wait for Steve to come back.
Okay. All I was going to say is, because this is more a financial advisor, but if you die, your spouse, partner will get, so I think what they get is about half of your pension benefits. So, and if you die in service, so if let's say you were 40 and you died, then your pension benefits would get calculated to what they would have been at your retirement age, and then you would take then obviously your dependent would get half of that. That is more a question for Steve, so I don't know where
it is. Steve, hello, Steve. Okay, let's carry on with the questions then that can apply to.
Can you hear me?
Steve, you're back.
Yeah.
Oh, I don't know what's happened. I've absolutely no clue what's going on here, but I can't see me. But
we can hear you, and for me, that is enough. And that's not personal. I'd love to see you as well. But okay, Steve, you've just returned just in time to answer quite a complex question. First of all, Andy is a GP, and Andy has a sense of humor because he said, "Thank goodness I'm not an accountant." If you want to know what it's like to be a GP and an accountant, tune in to the Medics Money podcast, because we are going to be asking Ed from Medics Money. He was an accountant, now he's a GP. So Andy wants to know that he has been buying AVCs for the last 14 years. Is it worth it? Steve.
Right, okay, so AVCs, additional voluntary contributions. Now, I suppose that's sometimes confused with added years, or sometimes accused with additional contributions into the additional pension. If it's not that, if it's the money purchase, or the defined contribution AVC, which I think now is run by Utmost and Standard Life and Prudential, then what he's doing, he's paying money into a pot of money that is going to be invested on. Oops, it's all gone now.
You're good. We can hear you. Carry on,
okay.
Steve.
Right. Okay. So so it's going into a pot of money and it's being invested, and the pot will be used by Andy to purchase a pension. Is it a waste of time? No, I think making a provision for your retirement is anything but it may be better if you may get a better outcome if you're buying additional pension, because you're then getting that guaranteed benefit and you know exactly what you're going to get. With the AVCs, it will depend on things like charges, it will depend on how the pot grows, and it will depend on what the cost of purchasing the pension is when you get to retirement. So no, not necessarily a waste of time, but there are other options as well.
Okay, good. Now, loads of people ask this question, which is basically if you go, if you go abroad and then stay there, or if you go abroad and then come back to the NHS, what happens? So Mustafa wanted to know this. Ziheng, who's an ophthalmology consultant, is going abroad for a few years and then is probably going to come back. So should we do it in two bits? What happens if you you are in the NHS pension scheme and then you go abroad and then you come back? What would happen, Steve? What do you need to do?
Right. Well, if you go abroad, then what will happen is that you'll leave the scheme as a deferred member. So your pension up until that point, provided you've got more than 2 years service, will be preserved. And then when you come back, if you come back into the NHS pension scheme, hopefully, well, typically that service will be linked. Now, it will depend to a degree on how long you're out for and what scheme you were in when you left. And as I say, how long you're out for, because if you're out for more than 5 years, then when you come back, you'll go into the 2015 scheme. Otherwise, you'll be linked to the previous scheme that you were in, and that service will just continue. So it will be how many years you work, how much you earn in your lifetime, or what your final salary is. So that's if you come back. If you go abroad and don't come back, then any pension that you've accrued will be paid to you overseas if you want it to be. Obviously, you'll need to take tax advice in the country where you move to. But I mean, I've had clients who've gone back to New Zealand and other places, and their pensions in payment are either paid to them here in the UK into an account here, or to them overseas.
Excellent. Okay, thanks for that. I mean, that's quite a common question that we had emailed through to us. Okay, I'm scrolling through the loads of questions. A lot of people are saying this seems really complicated. I think it is, but unfortunately it's necessary. And as I said, if you're F1, Carmen's popped up the link to get your total reward statement. You need to start doing that every year. That's just basic pension hygiene, shall we say.
I mean,
okay.
Just to say that it may seem complicated, and it is complicated, but it is a very, very important part of a member's total remuneration package. So it is important to try to understand it, and I don't expect anybody's going to sort of become an expert in NHS pensions, nor do they have to, but they should at least try to understand what it is they're going to be getting and what sort of level of benefit they're getting for the contributions they're making. And it's also worth pointing out, you do get tax relief on the contributions that you pay.
And I think it's just being aware. I mean, obviously, I always say younger doctors won't be necessarily affected by the annual allowance straight away. You know, it's once you've been working for a while, you've built up quite a pension. But you need to be aware, because if you're not aware, you know, I've got, you know, you can get caught out by some of these tax charges. So it is making sure that, I agree with you, you get your total reward statement and you're getting the advice, and and it's being looked at every year for you.
The total reward statement does offer a lot of very useful information. It's probably something that if you get it explained to in detail, you know, every year or even every other year, it will start to make sense. The other thing it will show you is how much your pension's gone up by each year. So what you've paid in, you can work out, because it does actually give you the employer and the employer contributions on there, and also what the pension is this year as opposed to last year. So you can start to see the benefits that you actually are purchasing every year of membership.
Absolutely. I think if your total reward statement's accurate and available, just get it. I mean, I really wish mine was accurate and available. It's neither, and that's nothing that I've done and everything to do with, well, I don't want to libel myself, but PCSE haven't been the best. But
hopefully over time they will become accurate, and the information, because it's obviously dependent on the information that the employer or the PCSE give to the NHS Pensions Agency. They can only work with what they've been given.
Yeah, I mean, mine was fine until 2016, and then PCSE took over the role, and then since then, mine has not been fine. So make of that what you will.
And that has been a lot of issues. You know, when I go and see clients, you know, that's exactly what I see, especially when I go and see GPs. You know, we can see their certificates haven't been processed, and we go and say, this looks like it's not been processed, your pension record won't be correct. So, it is so important to obviously get that all sorted.
Yeah, okay. This is a punchy one. Someone was asking, what is the point in getting advice from a specialist medical accountant because they're just going to advise you to earn less or pay less tax? So, I mean, yeah, Jenny, do you want to, you know, I mean, but that's a serious question because, you know, this costs us a lot of money. My personal accountancy and financial advice bill last year was a 4-figure number, and I never regret paying it because, you know, price is what you pay, value is what you get. But, you know, tell us why and who would benefit from your services, Jenny?
I mean, I'll give you an example. So it's actually an example of a GP practice. So I acted for a GP practice, but I didn't act for one of the partners personally. So we didn't do their personal tax return. And I said to him, I knew what he'd earned. And I said, look, you're going to be subject to the tapered annual allowance. I said, you need to make sure that your accountant is looking at this for you because you are going to have a tax charge. And he came to me, I don't know, a year or so later, goes, Jenny, I've just been told I've got £36,000 tax charge to pay. And so I looked at the staff, corrected a few bits for him, but he had in the region of £30,000 tax to pay. But because his accountant hadn't looked at it and dealt with it, he'd missed the opportunity to ask the scheme to pay it. So he had to remortgage his house to pay this tax bill. So when people say they hear these horror stories, they are that out there. What's really important is obviously, I mean, I'm going to say this, you know, I'm a medical specialist accountant. You need people that understand this stuff is complicated, and you need people to understand it so they can make sure, you know, if that client had, you know, if it used us or whatever, he would have had the option of asking the scheme to pay that tax charge. Because it hadn't been dealt with and the deadline had passed, he didn't have that option. So it is so, you know, it is really important.
Absolutely. I mean, I think, you know, if you get the right advice, then none of what we've heard about this evening is necessarily a problem, but you need to get the right advice from the right people. And this is a massive part of why me and Ed set up Medics Money, because we noticed that non-specialist advisors were more likely to give out incorrect advice. You know, if you're an accountant doing IT contractors accounts and a GP comes up to you and says, can you do mine? You're potentially quite a lucrative client. So you're going to say, yeah, I can do it. But, you know, specialist medical accountants is a very niche area, as I think we've demonstrated this evening. It's not straightforward. But then the question becomes, how do you find a good one? Now, you may have enjoyed Jenny and Steve's speech today, and you know where to find them. It's in the chat, info@rbp.co.uk. But what we do on Medics Money is that we have selected verified accountants like Jenny nationwide. They have reviews from other doctors, and those reviews are verified by GMC number. So Medics Money is a great place to find a specialist medical accountant or an independent financial advisor. There's loads of stuff on there. And as I say, if you want to contact Jenny or Steve, info@rbp.co.uk. It's in the chat. Okay, here's one that we get a lot. Dimitri is asking what happens to her, well, I'm going to say her, I'm assuming her, contributions during maternity leave.
So she would still be paying in, but so during maternity leave you will pay, because obviously if I don't know whether you would get a certain amount of pay for maternity, so depending on your contract you'll get paid a certain amount. Your tier rate, so you will pay an employee's contribution on whatever pay you've had, but your tier rate is set based on the previous level of earnings. So if you were paying a tier rate of 12.5% and you go on maternity leave, you're still paying that same tier rate, but it will be based on obviously whatever your contract. Hi, Steve.
Oh, hi there. Yeah. Well done, Tommy.
So you'll still pay it, but it'll obviously be based. It depends on what your maternity pay is during your maternity leave.
Okay, good. Someone's saying, where's the Medics Money podcast? It is on my hard drive. We have 5 episodes recorded. It is not launched yet, so stay tuned to your emails. We're going to be discussing everything, everything that you need to know. Okay. Lots of people asking how to get a TRS statement. I think we've covered that. Here's one that we get a lot. So we've got a GP locum who's working via a limited company. What happens to their NHS pension?
So if they're working through a limited company, they won't be able to pension any of. So if you're working for a practice, you've done your locum work and all of that is being invoiced by your company, you can't pension it. So if you're just doing all locum work and it's going through your limited company, then you'll be out of the scheme because you won't be paying it. So I've got clients, if they're doing limited company work, they may do a few locums that they do on a self-employed basis so that they can pension it, so they can stay an active member of the pension scheme.
Awesome. So we're firing through these because we want to get through as many as we can. So Mabeen is asking, at what point in my career should I be approaching an accountant? So essentially, when do you need an accountant?
So when do you need an accountant? I mean, obviously, it's when do you need to, certainly when you need to do a tax return, if you're, I don't know whether you're a GP, hospital consultant, but obviously once you become a higher earner and you're doing tax, you're going to be required to do a tax return. You're also going to need to keep an eye on the annual allowance tax charges because that can only be reported on tax return. So normally, if you're just employed and you haven't been sent a tax return, it's normally when people start doing self-employed work, but certainly if you're in hospital, whether you start a private practice, but it will be, certainly one thing you'll have to report is obviously annual allowance tax charges. But then, of course, if you've got rental properties and things like that, then obviously you're going to have to be doing a tax return.
Awesome. Kath is just pointing out, actually it's a private message, so that you know how to log on to Total Reward, verify your identity. Getting that Total Reward statement is totally key. Okay, here is one that we get all the time, and it's not a clear answer. I know the answer, but if you have a pensions problem, do you need an accountant, a financial advisor, or both?
Well, I would suggest it depends on the problem, and it may well be that you need both. So if it's tax related, then you'll need an accountant. If it's more sort of how much am I going to have, what are the implications of buying additional pension. So if it's a sort of more of an advice issue around the pension scheme itself, then you're going to need a financial advisor, financial planner.
Yeah. I can see Ed's manning the chat valiantly because there's loads going on in there, but he's just popped a link to a blog on the Medics Money website, which explains that in more detail. So let's move on. This is one that we were going to talk about, and it's definitely one that I've got a vested interest in. So Leanne is asking, if you know what happens if you want to retire early? So what would be a good financial strategy, Steve, if you know that you want to retire early, so you don't want to work to state retirement age? How would that affect your plan?
Well, if you know, well, that's a very, very tricky question, because if you're going to retire early, then we would say as financial planners, the question you need to ask is, how much money am I going to have, and am I going to be able to enjoy a comfortable retirement? Retiring early and living off baked beans on toast is probably not what most people are looking to do. So the first thing you need to know is how much you're going to have, and are you going to be able to fund your lifestyle through that? The other thing is, of course, then you would be looking to try to maximize the pension benefits that you could accrue during your lifetime, because if you are retiring early, you're also going to be subject to early retirement factor. So your pension, if you take it before your normal retirement age, will be reduced to take into account that you're getting paid it early. My recommendation would be, first of all, work out what you're going to need. Secondly, look at trying to maximize the benefits while you're working. And it does also depend which scheme you're in. I mean, if you're in the 95 scheme, the normal retirement age is 60. If you're in the 2008 scheme, it's 65. And if you're in the 15 scheme, then it's state retirement age. And so it will keep going up with state retirement age as it does.
Awesome. We just clicked over the hour, but we still have over 600 people with us. So if you guys are okay, can we carry on for a bit?
Yeah.
I'm just going through the questions. So a lot of TRS issues. Someone's asking, how do you get your TRS statements from previous years? So if this is the first time you've heard about TRS and you're in a blind panic right now, can you get the statements from previous years?
Well, I would imagine that. I don't actually know the answer to that question.
No, I don't know.
But I would hope. Well, you would need to ask the NHS Pensions Agency, because they're the people who upload it. So if you want previous years, you could ask them how to go about it. But that's really a question for the NHS Pensions Agency.
Yeah. I'm not sure that I don't think it's a way that you can log onto the website and you can click through previous years. Obviously, if you're a GP, within your total reward statement, there's a dynamised earnings sheet, which every year lists all your earnings. So if you've kept good records, you can kind of tick off, especially for GP partners, you can tick off and say, yeah, that agrees to all my certificates. But I'm not sure you can actually click through and get prior years.
And if you're worried, you can request a more detailed, is it a pension savings? I don't want to say the wrong thing here.
Well, the pension savings statement is the annual allowance stuff, but you can write to the NHS Pensions Agency and ask for a record of all of your service, and they will provide that for you. And then you can go back through that to see whether it matches up with what you expected to say.
Yeah. So I know I've seen clients send, and then they've got details of where they've worked, especially in hospital, and they've gone back and checked and said, actually, this is missing this year's. But I think you won't be able to get that on the total reward statement. You've got to contact the pension agency directly.
And they are pretty good, actually, when you if you request something from them, they do tend to give you as much as they can. But again, it's going to be dependent on what they've got from the employer. Yeah. So this gives you a check between what the NHS Pensions Agency know and the information that the employers have given them.
A lot of people are saying, if you have an annual allowance problem, opting in and out, the hokey cokey, I think is what we call it. Do you want to? We talked a bit about this, to be fair, but so someone's sort of saying, and we did cover this. If you stay out of the pension for more than 5 years, you lose the uplift, I believe. 5%,
yeah. That's right.
Yeah. So the hokey cokey, Steve, do you want to just tell us a bit about why some of your clients might do that, and a bit more about it?
Well, the reason people will want to do that is because they're worried about an annual allowance charge, and if you opt out, then your pension is preserved, and you won't have an annual allowance charge for the years that you're out. But when you come back in, if you come back in within 5 years, you're going to get quite a big uplift. So you're going to end up with quite a big annual allowance issue, probably or possibly at that point. So, but it's really largely to avoid having I think for most people, a cash flow problem. If you use scheme pays, you don't have that, but you have a smaller pension at the end.
I've got lots of I've got clients that do this within a year. They'll opt in for a couple of months and then they'll opt out. And what they're trying to do, so if they're subject to the taper and they're only going to get tax relief, or that they've only got £10,000. What they're trying to do is say, well, let me see if I can get my gross to only be around £10,000, so I don't have that tax charge. It's so messy opting in and opting out, and especially if you're a GP, you're dependent on PCSE opting you in, opting out. I had a client yesterday actually that I spoke to, and he'd opted out, opted back in, and then he tried to do a scheme pay election, and the pension agency said, but you're not in the scheme. And he'd opted back in, PCSE were taking deductions for him, but obviously there'd been a miscommunication between PCSE and NHS pension. So people do this, but there is a risk factor. You've got to be on the ball about making sure that this opting in, opting out is dealt with. Yeah.
Miscommunication.
The other thing I was going to say is, of course, while you're out, you're a deferred member, and as a deferred member, your death in service and all your other ancillary benefits are not as good.
Absolutely, yeah. And the hokey cokey is a suboptimal solution really to the problem. So hopefully the problem will be addressed at some point. Who knows? Jenny is apologising for asking a basic question, but it's not that basic because I don't know the answer. So Jenny is a GP locum, and she's now doing a combination of locuming and salaried. Does she have to continue to pension her locums because they are NHS work?
So locums have a bit of a loophole. So that actually, because there is this, so strictly speaking, you are supposed to pension all your NHS income, but locums have a bit of a loophole because you're supposed to do all the forms and get it submitted to PCSE within 10 weeks. So what you often find is that you can, in a way, if you've got your salaried post that you're pensioning, you find that if you're doing a bit more locum work, but you don't want to pension it, people don't do it just because you can say, well, I didn't get my forms done within the deadline. So strictly speaking, you are supposed to pension everything, but there is this loophole for locums.
Nice. So don't apologise for asking a basic question because that's something that I know now. Okay, Samantha we have kind of covered this, but let's go through it again because it's important. Samantha's asking that she hasn't been able to get a TRS or an annual allowance statement for the last 6 years. Not unusual, unfortunately. So basically her question is, if you don't get informed by the NHS pensions that you have breached annual allowance, are you safe?
No.
No.
In a word, no. But they are, if you request an annual allowance statement, or if you've exceeded the annual allowance in any year, then they have to send you a statement. They have to send you one by law. Now, obviously, it's dependent on the employer giving them all of the information to be able to calculate it accurately. But if she hasn't had one for 6 years, she really needs to make a very, very strong sort of case to the NHS Pensions Agency saying, look, I'm entitled. If I've asked, I'm entitled.
And I'd also be saying this is where accountants have to step in and do these estimates. And that's why it's really important that the accountant is making an estimate, because just because you haven't been sent one doesn't mean you haven't exceeded the annual allowance. It just might be that your pension record isn't correct. So no, definitely not safe. And yeah, and as I've mentioned, the issue is if your accountant doesn't do the estimates, you miss the scheme pay deadline. So if you suddenly, your pension record gets updated and you get these annual allowance statements, and you've got tax charges, you will have missed the scheme pay deadlines if that's the way you wanted to pay the tax.
Yeah, so it comes in a little brown envelope, and nobody likes to receive it. But if you don't receive the little brown envelope, just don't assume that you're safe, unfortunately, because it's a nightmare. Okay, Huda is asking, and I'd like to know the answer to this, but I expect there isn't one. Can you give us a ballpark figure of how much to earn or not to go over in order to incur a charge, or is it not that simple?
It's not that simple.
Are we talking? If we're talking about the annual allowance, then it's impossible to calculate because it's based on different things. I mean, first of all, you have an opening value, so how much pension you had at the beginning of the year. That's then uplifted by inflation in the previous September, and then you have a closing value, which is what you have at the end of the year, which is uplifted by inflation the following September. So you've got different figures for inflation, and then of course you've got the growth in the pension, and if you're a GP, you've got the uplift. So there is no hard and fast rule to say, because it depends on the growth, not what you've paid in.
Yeah, and it's looking at what you've already got as your pension pot and what you've earned, and that's going to be different for everybody.
And the other thing is, of course, if you get a big pay rise, then you'll end up with a much higher growth in that particular year, or if you get an award or something, so you need to be asking the NHS. I would suggest anybody who thinks they're going to have anything like near an annual allowance charge should be asking every year.
Awesome. All right, I think my kids will be up in about 5 hours. So a lot of people are asking, how much does it cost to get advice? I think it's impossible to answer that. It depends on everyone's situation. I don't know if you guys do a set rate that you want to talk about, or I mean, it's so situational. One person's self-assessment might be super straightforward. Another person might have 5 different streams of income, a limited company, a private pension and stuff. So I think the thing is, like I said, price is what you pay, value is what you get. If you use a specialist, via Medix Money, they will tell you if they don't think they can help you. Okay, shall we have like a closing message or take home from Steve and Jenny? And then, as I said, my kids will be up in about 5.5 hours, if they've even gone to bed yet. I don't know what's going on out there. And for all of those who are saying, can we go for another webinar? Stay tuned to your Medix Money emails. We're doing loads and loads of more of these. The podcast is coming soon. There's so much information on our blog. A lot of it comes from, all of our experts. So, Steve, do you want to just sort of, in summary?
Well, the main take home, I would say, is that the NHS pension is a massive part of the remuneration for members of the NHS. Most people would love to join the NHS pension scheme because it provides really good value and certainty. So before doing anything like opting out or, taking early retirement or 24-hour retirement, make sure you understand the consequences, because it is a significant benefit. That TRS, that total reward statement we saw, showed that the hypothetical value of that, the annuity value of that, was 1.2 million. That's a huge sum of money. Not many people accrue that within their private pension arrangements, and if they do, they're going to be exceeding the lifetime allowance.
Awesome. Thanks, Steve.
And I think really the only message really for, I suppose, from an accountant's point of view is, obviously, as we've said, it's really important to get your total reward statement, really important to be keeping records, especially if you're dealing with PCSE, so having copies of everything. And really, I suppose I would say this, but speaking to a medical accountant, knowing, have you got an annual allowance tax charge? Because if you have, if you haven't got the money to pay, you don't have to do that, but you've got to meet all the various deadlines.
Awesome. I think my fine sort of take home is that, all the way through medical school and our career now, we're not giving any we get loads of CPD to keep our clinical skills up to date, but we get no financial CPD. And a large part of what we do at Medix Money, supported by all of the experts who join us, including RBP, is provide you guys with financial CPD so that you can inform yourself to make the right financial decisions. It's super complicated, but, we have to do it because we just don't get any financial education at all. And hopefully this has been educational, informative. David, I'm not sure if David's got a bit of a sense of humor. He said it was the funniest webinar he's ever been to. There he is again.
New career in comedy then.
I think it looks like we're going to be doing this again. We got a lot more webinars planned in our schedule. So stay tuned to your emails. Thank you so much, Steve and Jenny. We've been going through the technical side of this all week and practicing. It takes a lot of time to put this on for you guys. So we really appreciate Steve and Jenny giving up their time. Ed, thank you for handling the chat. It's been crazy in the chat. And I think we'll say good night. And just to remind you, if you need any, if you want to engage an accountant, info@rbp.co.uk. It's in the chat. And if you liked what Jenny and Steve said, that's the place to head. But for now, we'll say good night. Thanks, everybody.
Good night.
See you next time. Bye.
Bye.